Hello, this is Chuck Carnevale, co-founder of FastGraphs. This video is being prepared in response to questions I received from two subscribers, one on Harris Corp, a regular C Corp or publicly traded company, and the other on VNR and MLP, and I'll start with Harris first. The question I received related to formulas for valuation, how they apply. It was actually asked about in regards to the Graham number versus the Graham formula that we use in FastGraphs. So let me just briefly state that we use three formulas. We use the Graham-Dodd formula, which we designate as GDF. We use a P equals growth rate formula, which we designate as P equals growth rate. And then we use an extrapolation of the two when earnings growth is between 5% and 15%. Less than 5% is the Graham number. Above 15% is the P equals growth number. And as you can see with Harris Corp, using a 21-year graph here, we have an 11% number. Therefore, we're using the Graham-Dodd formula. And that Graham-Dodd formula draws the orange line on the graph. And what this graph really represents, or what this orange line really represents, is in essence a theoretical, or I even often say metaphor of intrinsic value. Now let's analyze how that has worked on this 21-year graph where we have 20 years of history plus the current year we're in. You can see that the calculated PE ratio of that orange line is 15 by looking to the right here. So anywhere I touch this orange line, I'm looking at a normal PE of 15. Now, this is a tool to think with, so let's analyze what we're looking at here. Clearly, going back to 1993, the 15 PE has been a pretty fair proxy for valuation on Harris Corporation. It's actually been higher than that, or just maybe slightly below at a time or two for most of that time frame. Now, a couple of things have happened, which I'll elaborate on here a little more in a moment. One is we have the Great Recession coming in 2008, which essentially reduced the valuations of most companies. When I draw a shorter graph, you'll see this more clearly. But so something has radically changed. Prior to the Great Recession, the market had always priced this stock at a PE above 15. That is simply a piece of information that we now have. Now, interestingly, that calculates out to a normal PE of 19.8, and that's what the blue line on this graph is. It would represent a PE of 19.8. So to clarify, if the stock price is touching the orange line, it's trading at a PE of 15. If it's below it, it's less, and if it's above it, it's higher. Same can be said about the blue line. If the black price line is touching the blue line, it's trading at a 19.8 PE. If it's above the blue line, it's trading at a slightly higher PE. And if it's below the blue line, it's trading at a significantly lower PE. So as I look at this, I can see that there's been a normal 15 to, we'll say, 20 PE ratio that has been applied to Harris until the Great Recession, and then obviously the price has changed. So what has happened here, and what could we logically perhaps assume out of this? Well, my argument would be that there's two things. The recession brought all stock prices down into what I would call either undervalued or normal valuation for a time. But a lot of companies, for example, Procter & Gamble, which I will introduce into the video here, it dropped. It was always a premiumly valued stock, which is what we know when we look at Procter & Gamble. It came into fair value. Earnings held up reasonably well, and you'll notice now that Procter & Gamble is moving back to its normal 19.9 PE ratio, where Harris Corporation, if you recall, and I'll get back to it here in a second, has not had this type of recovery that Procter & Gamble has. These are just simply pieces of information that FastGraphs is readily revealing to us beyond what just a statistic. Normal PE is 19. It's currently trading at 18. Is it undervalued? And the answer is in my book, no. It's overvalued based on its earnings justified valuation metaphor, which I call the orange line. It's undervalued based on historical normal pricing. So again, it's a tool to think with. You do analysis when you're utilizing FastGraphs. Now, getting back to Harris Corporation, let's try to figure out what's really been going on here. Now, the best way to do that is to draw this as a shorter graph. So I'm going to start with a 7-year graph. I'm going to cut most of the years off of there and just look at the last 7 years. I actually forgot to change the symbol here, so let's look at Procter & Gamble. With Procter & Gamble, I have a similar situation. Notice that the normal PE in the last 7 years has much lower than its historical norm, but also notice that its operating growth rate has dropped significantly. So let's go ahead and add Harris in, as I originally intended to do, and let's look at what's happened to Harris. With Harris Corporation, now we see in this period 2007 to 2013 that, first of all, earnings growth is still reasonably high at 11.8% over this period of time. The normal PE, however, has been cut dramatically. It's now only 11.6 compared to its historical norm, which was close to 20. Again, we have a normal PE, a fair value calculated PE of 15. We have now a new normal PE of 11.6, and we can see that the stock is trading under that. But, this still doesn't give me a good picture. So let me drop 2 more years off of this graph and see what I discover as I look at Harris Corporation. Now, what I discover now is that the normal PE is actually shrunk to 8.8. Now, I want to clarify that. I still have my 15 PE here, but since the Great Recession of 2008, Harris Corporation has at times even traded below that. You can see year-end PE ratio by the end of 2009 was 7. It was back up to over 9 by 2010, back still over 9 by end of fiscal 11, and it was 8 at fiscal 2012, and it's currently 8.7. The normal, in other words, this simply becomes a measurement. We know this is 8.8 times earnings. This is above that. This is below that. It's currently trading right at that. So let's just quickly analyze a couple of things that may have happened here. Number one is we see that growth has slowed down. It's only averaged at 5.9% since the beginning of fiscal calendar year 2009. But what's really going on here? Well, a couple of points. Harris is a defense company. And one of the things that has been threatened by the federal government is a big cuts in defense spending. So we have a couple of things happening here. One, we had the market reduce stock values across the board, as I showed you with Procter & Gamble, but also with Harris Corporation. The difference is, as Procter & Gamble and others have begun recovering, we don't see the same thing happening with Harris. And my guesstimation of that would be that because there's threats on what the future of defense may look like. So the market is maintaining a low valuation. The point is that if I wanted to buy Harris here for its 3.3% current dividend yield, I think that this reduced valuation of 8.8 is probably fair. But now let's look to the future a little bit. The current consensus of 9 analysts reporting to Capital IQ are only forecasting estimated future earnings growth of 2.3%. In fact, they're estimating a negative growth in earnings for fiscal year ending June 2013, and then only a 1% growth following that, and then only 2% growth going beyond. I believe this obviously has a lot to do with what they're expecting to be happening with the defense industry. So Harris then now becomes in theory, becomes a low growth 2 to say 4% grower. Now, my argument would be this. The company is currently trading at 8.7 times earnings. And if you recall from the historical graph, that's about what the normal PE has been post-recession. I think the stock is worth 15 times earnings, even at this 2 or 3% growth rate. So when I look at this company, I would anticipate that I have the opportunity to possibly see a PE expansion where the PE could move back into the 15 range. I just can't tell you when that would happen. Is it going to happen this year or next year or 5 years from now or never? But logically, I would expect it to happen. And let me use an example. Let's look at a company like Southern Company, a low-growth utility stock that has only grown at 3% over the last 5 years, but commands a PE of 16.9 currently. If we look at it over the 15-year period, we see that it's consistently a 3.2% grower, but the stock has commanded a PE of approximately 15 or something close to that. And my point being is I don't see any reason why that can't happen with Harris again once all of the risk of the recession and / defense spending becomes, or at least the unknown risk, the risk of the unknown. In other words, once we get a better handle on what is actually happening with defense spending and so on, and if we can determine that, we really have a 3 or 4 or 5% forward growth rate in Harris Corporation based on this, new normal for the defense industry, then perhaps we could see an expansion. Otherwise, we're looking at buying a stock that's trading at around 8 or 9 times earnings, which would mean that we could expect to get maybe 2 to 4% growth and a 3.3% dividend. And that's kind of our margin of safety calculation. If we're willing to accept that, then we might want to make a position in Harris. Now, on the other hand, if you're more optimistic and think that Harris could go back to an 11% growth rate in the future, once all the politics and everything goes away, then you would have an opportunity to see Harris be a much more attractive company, but yet still based on a normal PE, or excuse me, on a fair value PE of 15, but because you'd have much more growth, you would be looking at a much higher future expected rate of return. So the point is, when you're analyzing a stock using fast graphs, the key is to look at what fast graph reveals to you. Don't try to automatically assume that these numbers are all absolutes. When I look at Harris over even the 15-year period where all the data is typed in, I can see that it's always traded at a PE above 15 until we had the Great Recession. It's been cyclical in the past. If I go back out to the 21-year graph, I want to point out that we've had periods of time where there wasn't much growth in Harris, like this period right here, and yet the PE ratio stayed high. So now we have the double whammy of the Great Recession, but we also have this idea that for the first time the government may really be making some big cuts in defense spending, which could have a long-term impact on Harris. Now, I'm going to stop this video here and go ahead and prepare a separate video on VNR, but I wanted those subscribers that have these kind of questions have an opportunity to have me go through how I would analyze a company like Harris Corporation in today's new normal.